Hello, everyone. I hope you're having a good afternoon and happy weekend. Weekend is upon us. So, today I wanted to just take a look at the markets and see if I could time a trade that deals with volume profile, and I'll go over volume profile deeper in the next lesson. But I was able to take a nice little position here with the mini S&P 500 contracts on futures and come cash out with a profit of 165-ish on a Friday. Normally I don't trade Fridays. It's a very choppy day. Market structure does show itself, but as you can see, we do usually have candlesticks that are trading sort of inside of each other. But this is my actual trading setup. It's looking a little bit different from the trading setup that I have when I am teaching, only because it's got everything that I like to personally look at when I am taking trades. So today I just wanted to go over a little bit on volume profile and how I use that to sort of give a little context and take a break here of how I actually trade versus, teaching, if you will. So over here, we basically have our volume profile. And what this is telling us is on the books, this mean line, if you will, is giving us information on where the markets are trading in and out of mostly during this day. If you were to take a look at historical information, it'll show you what the markets have done in days past. This red line represents the same line as the dark blue line here. And so on this particular day, the markets traded in and around this level, particularly of 5773.75. And as you can see, it hits this number over and over and over again on the day. If we were to rewind once more and we take a look at Wednesday, we'll also see the same story sort of develop here, with our information presenting itself to say around these levels on Wednesday, the target number was around 5701. And if we were to take a little marker, we could kind of see that around that area we traded quite a bit. One more time, we'll go over here into this area, which would be Tuesday. And we can see that on the books, the highest traffic was usually around 5721. And so how I use this is I will go ahead and take my volume profile. Now there's two different types of volume profiles that you can put on your chart. This particular graph that you're looking at would be considered an indicator, and indicators are just basically mathematical equations and statistics that have been plotted out to help a trader trade. So in the previous videos, that's why I mentioned there's a lot of information that you can pull off the chart without having to even add a indication yet, but this is one of my key indicators that I utilize day to day when I'm actually trading myself. So if we clear this real quick, we'll remove all the drawings. Essentially what I do when I come in is I'll go ahead and mark my key levels throughout my day on the chart here, but we'll sort of keep it a little bare to just have a little bit of a cleaner reference. And let's utilize yesterday. So essentially what is being done here is the indicator, and you have a huge list of indicators that you can use. The ones that I utilize the most are going to be starred, my favorites, etc. And then I'll also have sort of a favorites bar here with my fixed range volume also being there as well to be used at my will. So fixed range volume is what we'll go over today. I can go over visible range at some other time, but essentially this is taking the tool and going from a range that is fixed instead of the visible, which will sort of move with the market. So this is basically taking all of the information from the point in which I drag it over to the point in which I end the drag. So you go down to your list, volume profile, fixed range, and what we want to do is we want to take it from the top of the day and move it over to the end of the session, or the top of the session to the end of the session, if you will. And once we've clicked on that, then it gives us all the information that we need for the day as far as this indication is concerned. The blue line will be the point of contention or conversion, and then you will have pretty much a heavy volume profile. Now, the ones that are darker are going to be more reliable information. When you start to get into the gray extremities, it's basically saying that information was gathered there, but it's not as true or biased as the dark information here. And this is also saying that most of the market traded within these two ranges. So if you were to take a pen and you go over this particular range, actually let's do that a little bit cleaner because I grabbed a little bit more. Let's delete this. Are we going to delete? Oh, excuse me. Let's grab this, delete this. Okay, so we come over here and we grab our pen. So essentially what you're doing is you're going from the top of the node all the way down to the bottom of the node. So the range in which we just drawn would be our high volume range, if you will. And then within that range, we have our little POC, which is the blue line. And the blue line is basically telling us that within this range, we had a lot of activity that touched that particular price, came back, rejected off that price, traded through that price, came back up, rejected off that price, traded through that price. And if we reference our last lesson of support and resistance, we will know that we will usually see prices that we like, we'll reject off of them and then bounce again, and or trade through them and come back up. So essentially what's happening here with this red line is this particular indicator is mathing out an equation with the bell curve being on this particular indicator. So this red line is a bell curve. If you were to like kind of refer back to math classes and you did any sort of probability and statistics course, this would be sort of taking all your information of like, you know, say if X company sells this many products and these many products sold the most, but you're taking the mean or any averages and saying like, you know, maybe this product should be sold more often because it was this particular number of order or the item going out the door hit most. So essentially we're taking that information and going back to a Wall Street reference, if you will, and it's saying that live market in real time, New York and Chicago are usually liked this price yesterday. And so this gives us a lot of information here. This is what we would consider sort of our level 2 indicators, because the first indication would sort of be without any drawings at all, without any of our indicators laid on, as we went over in the previous courses, is, you know, how much information can you pull from the chart without taking an indication here. So if we had all of our information sort of bare, we could go through and, okay, so it looks like, you know, this level was a level of the highest high yesterday. We also could mark our lowest low, which was right around here. And this would be sort of like pre-market, so I don't necessarily determine this information. We'll take a vertical line so you see what I'm saying. So essentially we are going from New York open. If we tick it down to our timing at the bottom, it will be 8:30 my time. And so at the open of the market, after we've looked at previous information here, right, we wouldn't really know much of the information that would be going on. So say, for example, if we were looking at this chart just pre-market with this particular indication, which is more realistic to how I would wake up, I would only have information up till my open. Like so. And so we would understand that the price range up till open would have some sort of point of contention here. So I would go ahead and mark that with my ray line further. And let's go ahead and mark this with the ray. So I would go ahead and mark that with my ray line further. And essentially at that point in time, I'm taking a look at the markets and I'm saying, if I don't have any of this information, particularly in this box here, so we'll go ahead and let me see if I can block this out. Okay, so if the market is opening and I don't have any information there that's basically giving me any cues to say what the market will trade like for the rest of the day. So this would have been yesterday morning, waking up, opening up the charts for the first time. Now, of course, we would go back and do all of our analysis of previous past and see what information we have here. I didn't trade pretty much at all this week, so I don't know what the story is for the S&P 500 up until this point, but if I was looking at the information from just this morning and then going through and marking my points from yesterday, I would basically see if I have any information that tells me a story. Now, sometimes when you use indicators, they don't tell you much of what you're looking for, and you shouldn't go through and try to look for something, so to speak. But we would have understood that at the end of market yesterday, our closing price was somewhere along the lines of being at a level of support, if you will. So the breakout for the aftermarket hours tended to trade upward through the Tokyo session and the London session. So you could consider this half Tokyo, right? And then the other half London, and they will trade sort of just about after each other. There's an hour in between. And then, of course, when we get back up to New York, London is trading with New York at least until around that 11:30, 10:30 mark, depending on if you're East Coast or Central Time. And then you would just check your time frames if you're on the West Coast. But if we come back up to this bell curve, even then, our point of interest here over this particular session here, we're just talking about just the London and Tokyo session here, we would mark a price here to say, okay, for this session or these two sessions, 5773 was an important number. So I would then go in and say 5773, because that's a number to keep an eye on. That's a price range to keep an eye on, which is already marked by our curve here. So even say, for example, if we're going throughout our day, and we took our ray line, right, and we still marked that point of contention here with the ray line. As the market moves, the more information that is fed to this plot, right, the more information will come up. Now, this is the fixed range. So essentially what I do with the fixed range, because I just like the fixed range over the visible range, which moves with the market. So each time the market ticks, this particular plot is going to tick with it, and then the information is going to change here in real time. What I do is every single time a candle is ticked, I just go ahead and move this a little bit further, and then throughout the day, just consistently moving it a little bit further, a little bit further, a little bit further with each candle tick, right? And then this would mark end of day yesterday, so to speak. So if we didn't have any information leading up until that point, we would know, based off of that morning pre-market open, marking that line there, and then taking a ray line and sort of just going through the rest just to see what zone we're trading in and out of. The ray line stayed pretty consistent, which is this line here. We'll go ahead and change that to, let's change it to pink. The ray line that I marked top of session without having any information present itself after that particular moment of open, as you can see, it's still traded very, very, very similarly for the rest of the day around those levels. And so what does this tell us? So what I'm saying here is, let me get my brush back. Okay. So what's happening here is with the bell curve and the line that goes into the middle, if you were to take, for example, a look at the markets and you're having the information give you what you are looking for, and you're confirming a bias there because you're saying, okay, the information isn't all over the place, it's not choppy. My POC for that morning, right, was trending on par with the one that we basically marked out just to mock up to see if the market continued to trade along those lines, and it did. So at that point in time, we have two confirmations. We have the confirmation of the actual plot line that the indicator gives us, and then we have confirmation from our ray line that we create ourselves just to see if it continues to respect those levels or have those levels be a level of interest, right? So if those two are matching up, essentially what's usually going to happen here is that we would be able to mark along that POC, now that we confirmed that it's, just about as legit as it possibly could be. The price is usually going to trade around this level here, right? So this is a huge level of interest for the rest of the day. And how do we utilize this? Well, we'll take this little bar here, and I'm going to go ahead and make this lime green. Okay, so in and within this range, right, if we were to take our lesson that we just previously learned, which was our support and resistance lesson, right? So we'll go ahead and mark this. So this is essentially our support. And this is our resistance. With the volume profile, essentially what you're doing is you're waiting for the markets to trade in and out of that zone, and equally on top and bottom. So if you were down here with these lower levels and you wanted to get in to join in on a gain on the market or take it long in a long position, so you're buying in, say for example down here at 5871, what this is usually going to do is it's going to come up and then reject off of that POC, come up and reject off of that POC. Maybe it trends a little bit lower. And once it hits for the upside, it's usually going to trade up to the outer extremity of that bell curve that we see here. So the outer extremity of this particular bell curve. And then when it comes back down, it's usually going to reject off of that POC and come back up or trade down. Now, in this particular zone, you're going to be following your price action, because if we say have a strong bullish move with the candlesticks around this area right here, then we're looking to possibly reject off of it and continue to trade back upward. If we have, say for example, a strong bear movement through this zone, then we're usually going to be looking to continue to trade downward into that zone. So with this, you have opportunity for small moves, but you have opportunity to make profit. So say for example, if you wanted to take a long position from 5871, and you wanted to see the market sort of play out in the morning. So say for example, if this was market open right here, and you want to just sort of see the market develop, you want to see some structure develop, which you should be anyway. You shouldn't really be getting in right when market opens. The books are just absolutely crazy, the drawbacks are horrendous, etc. What you're doing as a retail trader is that you are waiting for the market to sort of open up and see what structures that we have. So say for example, if we are going through our day with the market real time and saying, okay, if we come up and if market open sort of was trending down here, then New York opens here. We come up from 5817 and our POC that we've already marked pre-market. So we already got our thing going with our ray line here, for example. If pre-market, the POC was here, and we've went ahead and marked it with our ray line to say, okay, let's see if we continue to trade within this zone. If in real time I see this come back up and reject off of, say for example, 5830, and I see it hold or have a strong movement to sort of develop some structure at the bottom end there on our support, we see our support levels are looking good, and then we come back up and we hold here at these same levels. So each time I drag my fixed range indicator, the POC is still remaining in the same spot. It's still within the zone of what I predicted would be happening for the rest of the day. Then by the time we come back down here, even if we break the bottom of our bell curve and start coming up from the top side, I'm looking to take a position here. For example, let me get my brush. I'm looking to take a position here where I've X'd. And so this is essentially to say I'm not going to have my long go all the way through the POC, because chances are we might come up here again and we possibly could reject off of these numbers and come back down. So my point of entry and exit is easily marked out for me at this point in time, because I know, because of 3 points before then, right, we've come up and we've tested these numbers, 2 points before then we've come up and tested these numbers, that chances are if we bounce off of these levels of support, we're going to come back up and test these numbers again. Now, at this point in time, it's probably a 50-50, because we could come all the way up, which in my model, let's just say we did. But even then, if we're trading through that zone, I'm either going to start trailing my stop, which basically means my stop loss is going to come up here as we continue to the upside, right? And then if we are in the green, we'll continue to the upside, which I can't grab it right now. No. If we continue to the upside off of that POC, then we're still looking good. But anywhere from these levels to this level here would be a nice profit with a futures contract. Now, going into this, I would probably be in probably 1 or 2 contracts long, and then eventually get up to 5 contracts or so. But you always want to check these levels, because you could reject off of these levels. So this would be the point where you would exit the trade. And if, say, for example, it continues to trade for the upside, it may come back up here in this area and still reject off of that. So essentially, it's small snipes, right? And so with futures, you're able to short as well, play the short side of the markets. So if, say, for example, we did trend all the way up to the upside, at this point in time, that's my first confirmation. If we come down and reject off of the middle levels, then we've essentially confirmed another bias. And then I'm going to be looking for my second confirmation. And that's because usually when you come up to test levels and reject off of it, you usually reject twice. It's not very often it comes up to reject 3 times, so that's usually like your golden rule. But at that point in time, you are still looking at the price action. You're looking at the volume down here, which we'll eventually go over. But if, say, for example, we rejected off of these numbers again, well, now I can also take a sale on the short side, going back down to the bottom end of it. So what this indicator does is it allows you to sort of take smaller positions. Now you want to have confirmation on them, because, say, for example, this could have ended up trading on the top end. So we don't want to really just take a trade every single peak and valley, right? We want to make sure that we're still confirming our biases, at least to have more confidence moving into it. But if I were to have taken a position here, long, right, then that would have been a nice, maybe 100 to 150. And then, say, for example, if I shorted it on the bottom end here, down to the levels now, pretty much climbing up. If we short down to the bottom, we want to short down to here, because it could basically bounce off of this and go for 3. Chances are it's going to go for 2, but just to play on the safe side and have a target profit in mind, which is what we always want to have. We don't want to just trade and say, get greedy and say, I'm not even going to have a target profit, because I'm going to want this to just continue to go long. Here is where I would have set my profit target, right around here. And then as far as a stop loss is concerned, because of the fact that we aren't breaking for the top side very much, it would be somewhere up here, because at this point in time, we're not expecting the market to go towards the top end if we are seeing strong indication inside of this area here. If we're not seeing strong indication inside of this area here to say that we are going for the top side. So let's go ahead and clear this and clean this up. And then so we'll go ahead and show this on the real markets. So we'll go ahead and go to, this is today, we'll go to yesterday. All right. And then we're going to go ahead and lay that fixed ranged indicator back down. Okay. And so this is the entire session, start to finish, Japan, London, New York. And so around these particular numbers, we have our POC that sits right here in the middle. And we can see that the action came up and touched it, traded through it, etc. So if we say, for example, have our curve once more, now these peaks and valleys, these are low volume ranges on the very bottom extremities here. And it's basically to say, like, yes, the price came and touched into these ranges. As you can see, our lowest node touches, or our highest node touches the height of the day, which was the high of the day, and then our lowest will come through and touch the bottom. The window will also show you where the wick is. So this light blue background will show you, okay, at one point in time, yes, this wick did come all the way, this candle came all the way up and touched, but retraced or drew back all the way down, which is, I mean, that's just absolutely atrocious. If you're going long here, you would have probably lost a lot on this candle. So when you are trading the markets real time, you really have to understand when the volume is super high like this, it can be very risky. But this is to say, if we were to go ahead and take a trade here, let me see if I can get my cleaner path arrow. Yep. We would see it come through. It sort of test and touches. It tests and touches. And we want to be marking our outer extremities of our bell curve. So let me draw this first so you can see it, and then we will go ahead and mark it with a ray line. So this is sort of our bell curve here. And then we'll go ahead and clear this. Now you see obviously where the numbers are. We have the ray line here. And we will just make this black and bring that solid so it's nice and hard for you to see. And then clone this and bring this down here. And this is all stuff that we would sort of pre-market, and then of course as the day goes on, we would be moving it according as we move the actual indicator along. So let's go ahead and clean up this curve. Now that you see the curve matches the outer and upper extremities, and I'm going to go ahead and clean up this. Let's see, these are my levels. Go ahead and do that. And what else can we clean up here just to make this super clean? Take off the VWAP. Okay. So with the information presenting itself, we have the POC right here in the middle. This is the upper extremity of our trades, of our node here. So you see how this line coincides with the dark portion of our node, of our bell curve, if you will. And then this is the bottom of our curve here. So if I'm trading this live time, I'm taking a look at it and I'm saying, okay, we have come through and we've tested those levels in the middle. What level is it? We have a price of 5,700. It's a nice even number. The market likes even numbers. And we've come through and we've hit. And if, say, for example, we're trailing to the top side on this one with a strong move there, what I'm looking for is, we can bring this in. What I'm looking for is for this market to essentially reject off of these numbers, right? And I could have taken this short. So we'll use our big arrows here. And so we've come through, we've tested this number, we've sort of tested around this number. The wick could have also touched down on that number there. Come close to it, and then now we've officially tested through it. So you could take a long here, right? You are setting your take profit somewhere along that range at the top end, you're setting your take profit somewhere along that range at the top end there, such as, right? And you are setting your stop loss somewhere down here. Right below that POC. And so within this range, well, what other information does this tell us? Well, if we were to hide this, I don't know if I can hide it. Yeah. If we were to hide this, we would also see that we have, and on my chart, I like purple and black. My purple represents a bull run. My black represents a bear. So we have strong respected candles on this move upward, and as we taught in previous lessons, strong respected candles just means that we are not trading side by side like we are here. Each candle has room to breathe, and we have a strong push upward. Now, this is pre-market, so the volume's not really going to give us much indication there. This is just for example's sake, but because of the fact that we've come and touched down on this particular line here, we've come and touched down on it again. Well, if we couldn't see anywhere in the future here, right, and maybe we got a few indicators, we have moved 10 minutes on this move, and this particular half candle is still developing here. So we'll go ahead and pretend we can't see anything more than what we have in front of us. Previously, if we've rejected off of these levels multiple times, we come back up and retested, and then rejected off of these levels again, it could be time for a nice little move forward. Now, if I'm taking this position, I'm seeing this large bull candle close here, and I'm waiting for some sort of rejection off of the POC here to go towards the top end of it. And like I said in the previous video, we don't want to see candles closing half and half within the zone. We want to have a strong respected indication coming out of the move here with a strong respected candle, barely any overlap, and going forward. And so if we were to take a position here without even taking a look at our volume profile, we understand like this is a strong move, right? So we're still pretty much in profit in the green. We're not really losing any momentum, and we're coming up to our levels in which we said we were going to take profit on, which would be marked around 5709. And say if the market continues to produce, we basically take profit here, and we take a nice profit. We're green on the books to start our day. Now, the reason why we get out is because we're reaching the outer extremity of this particular bell curve, right? So this is a good place to know that it's going to come up and reject off of these levels multiple times. And what did it do here? Well, once more, it came up and rejected off of this particular level. And so what we want to be doing is we want to be out of the market by the time that this rejection happens, and we want to be taking profit here. So this is a powerful indicator. And you know, when you have a strategy, you want to just basically be sticking to it if it works for you and refining it while the market moves. This is one of my number one strategies here. It's very simple, and the more simple the strategy, the better. Like I said, nothing on the market is easy, but you want to at least make your life make sense, right? So you don't want to be looking at chart information and saying, okay, where the hell do I start? Where do I enter? When do I exit? And this is just one bias, and it's a very powerful one. The same way that the candlestick action was a good bias, and it was also a powerful one. The same way that the levels that we just talked about in the previous video was a strong bias indicator, and that also works. So essentially, if you were looking at the prices and marking your levels for like previous highs of the week, yesterday's high, yesterday's low, the weekly low, the weekly high, you can even get into weekly kickoff low, weekly kickoff high, etc. The high of the market in the Japanese kill zone, the high of the market in the London kill zone. There's so many different ways that you can basically mark up your chart. before you even use indicators such as this. And you're just basically going in and saying, okay, level 1, I'm looking at my price action. Everything looks good and in the clear there. Level 2, I'm taking a look at my zones, my supports and resistance zones. And then level 3 is now I'm laying on my indicators or referencing my indicators now. If you have a green check mark on, okay, price action looks good, level 1 looks good. That's one bias, right, as to why you would want to get inside of this particular position. Level 2 could be, all right, are we coming up and rejecting off of our areas of resistance, or are we bouncing off of our areas of support with strong momentum to the upside, or rejecting off with strong momentum to the downside? Yes, we are. Okay, so that's check number 2 to enter this position. And then check number 3 could be an indicator that you like, particularly for this. For me, it's this fixed ranged volume. So this is the last bias that I will take a look at before I enter a position. If all 3 check out and all 3 looks good, then I'm entering a position. And what I like about this volume profile is it allows me to have a clean exit no matter where I'm trading. So for example, if we were taking this short instead, right, we see this trading sideways, so we don't trade sideways, but we could have had confirmation on this short candle here to say that sellers are stepping in again. We have on our volume profile, which is another indication to go into a trade. We have on our RSI, we're crossing that 50 line, which is another indicator to go short on a trade if we're coming from the top down past the 50 line, right? Which we'll go over this too, and we'll go over this too. But if we were taking this short, we would have taken it short. We would have taken profit actually on this same exact candle run right here, and we could have made a profit on this tiny little window here, and then we would have been out sitting on our hands. We would have seen that the market would start to trade sideways on top of this level of POC. We're not breaking away from it at all, and then we're just waiting for the breakaway. And like we said, you know, there's a 50-50 chance that it continues to trade down to the bottom end, which it did. And so you could also have had a short here, right? And then you would have waited for the sideways trend to end. And in and around this line, I would say more realistically here, you could have also taken a short here. Now, there wouldn't have been really much indication to know that the sideways trend was over because you're not necessarily like trading in or out of that zone completely. But even if you wanted to say safe bets and wait until the candles move out of the particular zone where everything was closing, we have equal lows here on each of these closes. So after waiting after this doji candle, if this candle was showing strong downward momentum, you could have gotten in here and or here and come down and catch or caught the way down and bounced off of that outer extremity, the lower extremity of that bell curve again, which is where this line is representing. If, say, for example, you don't like to trade longs and shorts, like myself, if I'm going long on positions, I'm usually long all day. If I'm shorting the market, I'm usually short all day. I don't like to interchange them because then things just sort of start to get a little squirrely because you start to try to trade both sides of the market with the ups and the downs. So say, for example, if you were just going long all day, you could have waited for this move particularly to be over to show confirmation. And then once more, when we break below these levels of indication here, once more, when we're looking at these candles, we do not want to see the candle close the body within of that range. We want to see it break out and break out in a strong way. So you could have caught this particular breakout up to the POC once more. Now, even though the trade continued, right, with us setting our stop loss here, even though the trade continued in the positive, you were able to take profit here. And then you would have been sitting on your hands, and you would have been happy that you're sitting on your hands, because after this, the information gets choppy and our indications aren't really telling us anything. The price action has sort of faltered because now we have these massive wicks and there's not much information that we could take from a zone like this. So we shouldn't be trading this regardless, right? with these massive pullbacks, and we just don't know. We can't really read much information from here. It's not as clean as this move here, right? And so we would have been out of the market. This would have traded sideways here, and then we would have sort of been like in the chop for the rest of the day. This would have been late afternoon East Coast time. So all this is just essentially to say, you know, this is the power of an indicator, which is just confirming one single bias that you have inside of the market. And then you have other indications to say, okay, now we have 4 reasons why, or we have 3 reasons why to enter the market in a position here. So if we go over to today, I ended up making a cool $160 on the trade. Now, once more, I do not usually trade Fridays, but through wanting to go through the volume profile indicator, I saw a position and I took it, and I said, okay, let's go ahead and take this and see where this takes us. Now, days like this where it's trading a little bit cleaner as far as crossing over that POC and crossing up above it, even better. The other day that we just previously looked at was a little bit choppy, but it still shows you the information that you need to know. So we have pretty much market open, the Japan session, the London session, and then we sort of get into our 8:30 mark, which is right here. And we'll go ahead and just do this. Get a ray line. 8:30. And I'm only saying 8:30 because, you know, you usually want to give yourself a bit of time. The market opens up at 9, but we'll just sort of mark that as such around that range. Doesn't have to be perfect. So at this point in time, the information really wouldn't be giving us much if we were looking at it pre-market, but we just want to make sure that we see how it shapes up, because usually the pre-market isn't going to give us much information. They usually trades within a flat zone, flat zone, flat zone, flat zone, right? And so as the market shapes up, what you will do is you will just basically mark your extremities. And here actually is a good example of showing you that we could have 2 curves on one, which essentially is not as difficult as it sounds. It's just basically saying, okay, here's the outer extremities of this particular node, and here's the outer extremities of this particular node, right? And so as the day progressed, our mean sort of developed on the lower extremity, but if you wanted to take a ray line and sort of mock the same thing on the top end, you can mark these levels all the same too. And that's just to say, okay, when you are within this particular range up here, let me show you this in detail. When you are within this particular range up here, it's going to be trading different from the range down below, but both pieces of information are valid. So today was a 2-node day, and that's fine. Essentially what I do to see this is I'll go ahead and mark the bottom extremity once I've marked sort of like my bell curve, or even if I take ray lines and do the outer and the lower here. And then I'll go ahead and take a zone and sort of clone it and then drag it upwards. So that way I have 2 colors that basically shows me the extremities of like my 2 nodes when they are touching each other, and then this will just be a different color here, right? And so more realistically, I wouldn't use a ray line, I'd use a trend line, and go right in the middle, the highest peak in the middle of the trend there, and mark this line too, and make it blue so it mimics. Some days you might have 3. It really just depends what the range of the trading day is. But essentially here's what we have, right? And the information is pretty much the same top to bottom. I'll go ahead and clean this up. Right? So if we were to take a position, let me get an arrow. Let's say, you know, we come into the markets, we open up, We are officially trading the New York market. We trade down into this level, particularly it's 5763. We trade past it. Okay. So now these inner zones also become good points of profit. So if we wanted to short there, we could have done that. If we wanted to short here, we could also do that. So you could look at the market and say for the remainder of the day, so long as we are going within this range, short or long, we are going to go ahead and take profits in the middle of the range only, unless a huge opportunity presents itself. I wouldn't trade the lower extremities on days like this because, say, for example, if we were trading the middle, it would get a little confusing when you come down here, but we can always still mark it. So this would be the lower extremity of our bell curve on curve 2, right? And sort of that peak and valley there. Even say, for example, if you wanted to go ahead and only short inside of this zone down to the bottom end, you could. There's room to make profits on the top side, right? Or the bottom. And then the top side, right? Which was not the true bottom, but actually I took a position somewhere in here, but I'll show you that because I recorded it. But if you're coming into the day and you're starting with this, you really only want to be trading short or trading long, not both. If you're trading futures, you can't really short the market when you are trading regular stocks because you'll need to have $25,000 in the bank. With futures, you do not have to have that little trading rule does not exist. So you can short as much as you like. So even if, say, for example, with the two POCs here, we have so many points where we can officially enter and exit with this developing. Even if, say, for example, with this particular move on the market, we were only able to be looking at, you know, say, this bit of information hadn't developed yet, okay, that's fine. There's still plenty of time for a move to present itself because throughout the morning, right, and from New York Open, we have plenty of opportunities to make money. Now we opened and we fell off a cliff. We touched down on one of our POCs. We actually traded through it. So reaching the bottom here, which is inadvertently the other node's POC, is a good point of contention here because now you could basically follow through on the bottom end because you know exactly where your middle of the marker is. So if we traded through here, for me, this probably wouldn't be enough confirmation to take it short, but a long opportunity here could also be tasteful. If, say, for example, you set your take profits to be just on the range because you're trading in a disciplined way, you know that you'll always take your profits right as we hit the line there, which is a good thing. And then, say, for example, you were doing your stop loss down here because you see a strong push up to the upside right below your lower extremity, right? And with this being so tight to the action, your ability to lose money on a move like this is like really small, right? But your guarantee towards the upside is extremely large. So this allows us to see two things. It allows us to see our clear peaks and valleys, our clear levels of support and resistance, and it also shows us why we don't trade in the middle of the zone. We don't take entries here unless we are going towards the top end in a strong way or towards the bottom end in the strong way, because we do have the possibility of trading sideways in zones like this. So say, for example, if we were coming down short off of this POC, the lower POC, we would want to see a very, very strong bullish move towards the bottom end before we enter a position here. So, which it did show us, right? So we have a doji candle here. What did we talk about in the beginning of our technical analysis course? We said if it's a small body, whether it's bull or bear, it's just not enough momentum to enter a position. so we wait until we have larger candles. Now these candles are large here, they're respected. We could have shown signs of a retracement, but we continue to trade lower, and at this point in time we're trailing our stop. We came down and we touched that line. This could have been an indication for the top end, but once more, it's a small body. It's not necessarily carrying the momentum to the upside, so we're still very good on this short, for example. And then we touch down, exit at our lower extremity on that bell curve, and have a clean short and make profit there. Now, with this strategy, for example, I don't necessarily just turn around and then take the top side. Like I said, I'll go ahead and only have shorts in mind, or only have longs in mind, because if you take greed out of it, right, at the end of the day, you're going to have equal amount of opportunities to short as you would to go long. So you don't have to take the long and the short every time. This is still today, and what time is it? It is 3:06. So we're reaching into aftermarket hours. However, once more, right? If the markets were still open and on the books for everybody to continue trading, then we did exactly what we know we would have done, right? So we came up to this outer extremity on this curve here, and rejected right off of that. Beautiful. We're probably going to come down here and test these numbers, since we just absolutely trailblazed through the first point of contention here, and we're probably going to come down here. So if we were to take this short from, or if we were to have taken this move and taken it short from the top off of these numbers, in which it rejected off of 5773, once more 5773 on the day. This is the story of the day. We're rejecting off of that. We rejected off of it multiple times yesterday, actually, and this is why, once more, we go back and we look at all of our information from previous days. This is what tells us as much as possibly can for how today could shape up, not how it will, but how it could, because once more, we cannot predict the markets. We can only go based off of previous information and use the best bias that we can to go into the next. So we've gone ahead and rejected off of those numbers of 5773. So 5773, even if I was doing my aftermarket homework, I would basically highlight that 5773, because at the end of the day, we're going to go ahead and taper off, right, and continue to probably trade flat through the Japan and London session. And at the open, we could reject off of these numbers down here and trade back up to those numbers of 5773. So that might be a move that we're looking for tomorrow. Market open, we could trailblaze back up to those numbers, etc. So essentially, this is to say that this type of information just daisy chains from day to day to day to day to day, and it, like we said in the last video, these patterns just present themselves over and over and over again. And particularly with the S&P 500, this is my bread and butter on the futures market. I love trading the S&P and the Russells 2000. So even if, say, for example, we were to come down here, right, and I can teach you the RSI indicator in the short future here to make this make more sense, but this is also one of my favorite indicators, because once we come up over the 70 line, this tells us that we are overbought, historically overbought, rejected, historically overbought, rejected. We could go back. We come up to these levels of being overbought and we reject. So when we come down to this 50 line, this is basically the middle of the range, right? So if it crosses over this line, then chances are it's going to continue to trend down to the downside of the move here. And so that's what we are looking at real time above in this is particular zone. We're looking for like a short here. Now, will it move all the way down there in the off? It may or may not. But all the indicators are sort of showing us that it will. And when we come back down to volume, when you have huge spikes like this, the chances of the volume coming back up and matching that again or even beating it is super low, right? So the volume is going to eventually taper off here, which means our stocks or futures contracts are going to taper off, which means our RSI is going to taper off. So these are just small confirmations for bigger information based off of previous information inside of the market, and also our indicators, the indicator that we are using with this fixed range. So there's very many ways, right, to enter a position where if you were to had opened up a trading terminal for the first time, you'd probably just be trading off of candlesticks, and you wouldn't know what zones that work or which zones you need to stay away from, like sideways trends, etc. And you probably wouldn't have like a strategy. And strategies are really just, it's a checklist of what can you see and confirm before you enter a trade. Right? And so when people are selling their strategies for like thousands of dollars, I think that's absolutely ridiculous. That's why I'm doing this course for free. It's essentially to say, like, by the time they're selling their strategy to you, it's already too late, and or it's nothing that you couldn't sort of like develop on your own based off of just having the bare bones of a the way that indicators or a certain action moves. And so this is also how you get into backtesting. So if I were just backtesting on a Friday, because I usually don't trade on Fridays, and if I do, it's with paper, then I would just be going in and testing my entries and exits and saying, okay, yep, if I were trading live, that's exactly where where I would have been in and out of, etc. And or if I were to get in on a position long, where would I do it? Let's test to see if the market opens up. Let's test to see if I take a position, say for example in the short right away, what is the probability of me making money as soon as market opens? And if I test this over and over and over again, and I am either down here or up here on the other 50%, then it's not good enough for me to want to trade that live. So then you come back in and you back test again. You say, okay, taking a position right when the market opens is actually not a good idea. Let's see how many times I can win when I see that like the price action has gone ahead and touched down on my points of contention multiple times, just to continue to confirm throughout the day. And then let's see what happens. What's my win rate if I'm coming into the market, particularly on like what you would consider the third move, right, instead of like the first one. And you just continue to do this with paper until you are proven inside of your strategy. And then after that, if your strategy is working for you, there's no point in you trying to go around and like find new ones or pay for new ones. That's something that also is just, it's not very wise to try to pick up like 50 million strategies. That's why people always say if they're wiser, they say, trade what works for you. I see people trade as clean as, like, say for example, just marking certain levels on the top end or the bottom end, and they understand that, like, say for example, they don't really need the fixed volume range, because they're basically just going along and saying what levels touched the most, etc. So it really is up to you, like, how you want to go through with trading. And of course, you don't trade a strategy, or you don't trade advice, if you will, until you've tested it and you understand it fully yourself, right? So say for example, I made a post on Reddit about my strategy, and inside of the Reddit post, I just basically said, hey, this is what works for me, but before you try it yourself in live time, just continue to back test it and make it your own, because somebody might look at that particular strategy with the fixed range volume and say, okay, yeah, I see that it works here, but I also use this other strategy. How can I couple this together, right? You also see like a lot of people trade ITC, which is inner circle trading. They might take this and like try to hybrid it with this particular profile, etc. So there's lots of space to like learn how to do things. There's not just one way to trade. It can be overwhelming if you try to learn like literally every single way how to do this. You have to like really just make it as kindergarten as possible for yourself so you can continue to follow those rules day in, day out. And if it's making you a profit consistently, then stick with it. So in the next, I will go ahead and show you the trade that I took. Okay, so this is the trade that I was in earlier, and essentially what we're looking at here is my light blue lines are my extremities for my bell curve, right? And the ES was moving in a weird way today. It was very choppy on the bottom end, but the ES tended to trend upwards with the NQ, which is the NASDAQ today. So the NASDAQ was actually looking pretty good long. So I went ahead and entered a position right where we are here. And as you can see, I am about $52 to $48 in profit as this market moves. I'm 3 contracts in long on the micro S&P 500. This is not the full size S&P. You could trade micro contracts the same way you could trade fractional shares. And essentially my take profit on the very, very long side was the outer extremity of my top end bell curve, as there's 2 nodes developed on this day, as we just discussed. And so essentially it's to say, okay, I could take 288 on the very long, but let's just see if I can just snipe a small profit here. I'm happy with bringing the take profit down to size to sort of meet or match my POC here if we come close to it. And my stop loss on this trade is down well below the levels that it usually is, but I just wanted to see this trade play out so I can show you the strategy in which I use it. Now, my stop loss usually is going to be a lot lower. Usually on a trade, I'm risking anywhere from $150 to $200. Maybe on a big move where everything is really confirming and I plan on adding size, it's $250. But this was the risk reward ratio. Now, I always plan on moving my stop loss to go up above my take profit, or excuse me, my entry. And so this is to say that if the market comes back down to the levels that I entered, I at least break even on the trade. So what happened here is the trade is looking really good. We have very strong bullish momentum. We're coming back up above the 50 line here. So when we break above that, we're usually breaking in for the top side. And at this point in time, I just want to go ahead and trail down this position. I usually don't trade on Fridays, so I was looking for the 150 range to take profit on. But if it ripped super high and we go for the top end of the upper bell curve, that would have worked too. And so this is just me sort of keeping an eye on it, making sure that all my levels are still looking good as far as scrolling back a little bit, tightening up the screen and getting ready to trail this down. Now the drawbacks are extremely large on this wick here. So this is basically saying that this wick is coming up and touching these levels around the VWAP, which is the purple line. So we could just say 5, 7, 5, 6, 25 and drawing back down after that. I believe that we were coming in on the candle closing. We were at about less than a minute, I would say 20 seconds. And also with the 15-minute coming in to close 5 minutes after that, we were still looking pretty good and in the green here. This is what we want to see. If this thing were to have ripped all the way back down to where I got in at, I wouldn't have lost money on this trade. I would have probably paid the fee that it would have been to just trade it in general, with the stop loss coming in at 750. And so we didn't quite make it up to the the upper extremity, but we did end up passing the POC. So I'm just sort of trying to trail my loss here without having the market come and take me out, even though we might trend higher. And so what happened after this is that we ended up trading sideways around here anyway. But we've gone from a position down here and traded up to the POC, which is a position I take over and over again on the S&P 500 to make small profits. And so if it were to have traded all the way up, we do have another node that's basically developing here. So we are essentially reaching the top end of the bell curve on this particular volume profile. And so I'm taking my take profit and putting it just above that, because I understand we're probably going to rip up into those zones or somewhere close to it, and then probably reject off of these numbers around 5, 7, 5, 6. And so I'm just keeping an eye on things. I'm keeping an eye on my take profit, which is sitting around making $92 on this trade. I'm 4 contracts in. I was 3 long and I added another. And so we're ripping upwards, and I'm essentially just saying, okay, if we pass this upper extremity of the bell curve, which we were looking to do, that's enough for me to say, okay, this was a good trade, which we did, and it stopped me out, or took me out, on a take profit of 167 on this trade. So this is essentially to say, if you were to have gotten in here like I did, now I waited for strong confirmation on the bullish end, right? We'll go ahead and come back here and pause it. So here, this trade just so happened to reach the upper extremities after I was out of the trade. At this point in time, I was no longer trading, but I went back and took a little screenshot just to show you. We ended up not going back up to the outer extremity of the top bell curve, because like I said, there was 2 curves that came in today. But when we're down here, I'll just go ahead and disappear the line up top, so I have just a clear indication of the zone in which we are trading in. We went up here and we went ahead and tested those numbers again, and then eventually rejected off of those numbers. Now we're close to market close on the ES, so chances are we're going to go ahead and bounce back like we just saw. But then also we were sort of, you could look at this as being oversold on the 50 line, because the POC line kind of coincides with your 50 line, so you could have looked at it as being like oversold. So you don't want to like take this long, and just sort of like a tidbit with taking trades like this, for example, and obviously this is all just advice, it's not telling you what to do, but usually when you trade up to the POC, the chances of you continuing to trade through that zone, it's literally 50-50. So at that point in time, you really want to be just like looking at the price action, not the actual indicator itself, but the price action around that line. Like say, for example, if we were taking this particular portion short and we got out here, we would probably be thanking ourselves, because we just trade sideways here. So that's something that didn't trade through right away, but then it ended up falling off and tapering off, touching down on the lower bell curve, trading through, and then coming back up to that POC. So this could have been another long, which is what I took my profit on. So we could have had 2 long positions today. And when you go into the market and you are sort of developing a more mature standpoint of how you take your trades, usually you're trading 1 setup to 2 setups a day, and that's it. And so if you're using this and you are just letting the market develop and you're looking at the information, this could have been trade number 1, and this could have been trade number 2 if I traded Fridays. But if, say for example, this was a Monday and I saw the information from yesterday, the day before, and how the market was shaping up today, then I would have enough information, if we were trading in and around these levels yesterday and the day before, or even just yesterday, Xing it off, Xing it off, Xing it off. I'm basically confirming a bias to say, okay, if we come back down underneath these levels, we're probably going to trend back up. So I would have taken a nice little scalp here. And then today you saw that I took a scalp here in real time. If you were shorting, then you would just basically say, okay, scalp here and scalp here. Small little moves, making small profits, and just sort of building up for the day, even if it's just 2 of them. And then obviously after that, you can just basically add on as much size as you want, or trail it up or down. Thank you for watching. And then of course, if you have any questions, I know this was a lot of information, just please feel free to ask them down in the comments below.